What if you could buy a gold bar in London for $2,000 and instantly sell it in New York for $2,010? For a few seconds, you've discovered a glitch in the market that allows you to make $10 with zero risk. This is the hidden world of arbitrage, the strategy used by Wall Street whales and high-frequency algorithms to print money from thin air. Today, I'm stripping away the jargon to show you exactly how it works. Welcome back to Finance Files. We've explored the stock market and the dark side of corporate scandals. Now, we are diving into a technical masterclass on financial instruments. By the end of this video, you'll understand the different types of arbitrage, how technology has changed the game, and why the free lunch in finance is much harder to find than it used to be. Section 1. The core concept: spatial arbitrage. At its simplest, arbitrage is the simultaneous purchase and sale of the same asset in different markets to profit from a difference in price. This is called spatial arbitrage. Historically, this happened because information traveled slowly. If wheat was cheaper in one city than another, a trader would buy it in the cheap city and sell it in the expensive one. In the modern financial world, this happens across different stock exchanges. If Apple is trading for a penny less on the NASDAQ than it is on the London Stock Exchange, arbitrageurs jump in to close that gap. Section 2. Retail arbitrage, the everyday version. You don't need a Wall Street desk to use this principle. Thousands of people practice retail arbitrage every day. They go to a local clearance aisle, find a toy for $10, and list it on Amazon for $25 because that is the market price online. They are profiting from a localized price imbalance. While this isn't risk-free due to shipping and fees, it follows the exact same logic as the big banks. Finding an asset that is mispriced in one location and moving it to where it is valued higher. Section 3. Merger arbitrage, betting on the deal. Now let's get more technical. Merger arbitrage happens when one company tries to buy another. When Company A announces they will buy Company B for $50 a share, Company B's stock usually jumps to around $48, not quite $50. Why? Because there is a risk the deal might fall through. Arbitrageurs buy the stock at $48, betting that the deal will close. If it does, they pocket the $2 difference. It's a high-stakes game of corporate poker where the instrument is the merger contract itself. Section 4. The role of HFT, the speed of light. Today, most arbitrage isn't done by humans. It's done by high-frequency trading, HFT algorithms. These computers execute thousands of trades in milliseconds. They look for tiny price differences across the globe that last for only a fraction of a second. By the time you see a price on your screen, an HFT bot has likely already spotted the arbitrage opportunity and closed it. This is why risk-free profit is so rare for individual investors. You aren't just competing against other people. You're competing against light-speed computers. Arbitrage is the glue that keeps global markets efficient. Without it, prices would be chaotic. If you enjoyed this technical deep dive into financial instruments, hit that like button and subscribe to Finance Files. We are building the most comprehensive educational library for the modern investor. I want to hear from you. Have you ever tried retail arbitrage, or do you prefer the traditional buy and hold strategy? Let me know in the comments. The market never sleeps, and neither does the search for value. Keep learning, keep growing, and I'll see you in the next file.